These are 6 of the best recession-proof ETFs that you could hold in your investment portfolio. So it's 2025 right now. Currently, the markets are down pretty steeply from the top. We're currently sitting at about 15% off the top, but at the lows, the S&P was down over 21%. And of course, the NASDAQ was down slightly more than that. So this actually qualifies as a bear market, not just a correction. And a lot of people are suggesting that we might see a recession later this year. Goldman Sachs has the odds of a recession in 2025 at 45%. JP Morgan has it at 40%, and if we look on Polymarket, which is the betting site, they have it at a 62% chance of a recession this year. So given that the likelihood of a recession is increasing, global markets are tanking, a lot of people may be wondering what are some solid recession-proof investments, and I have compiled a list of 6 of the best ones that you could consider. Each of them is in a slightly different category, and I'll explain why they are recession-proof. All right, let's start out with the first one. Now this one, the ticker symbol is TLT, and this is a bond ETF. So this basically just holds 20-year treasuries, and typically, normally during a recession, bonds will outperform equities. And so this is a pretty standard inclusion in a lot of portfolios. If you have an allocation to bonds, TLT is a solid option. They have over $48 billion of assets under management. So this is one of the biggest bond funds that you can find. It's traded on the NASDAQ in the US. They have an extremely low expense ratio at 0.15%. And if we look at what is actually contained in this ETF, yeah, it's literally just treasuries, which are US bonds, 20 years here, and a small amount of cash. And then if we just zoom out and look at the price chart of this one, you can see that in 2009, when there was a recession, it had a little spike. Then if we zoom into 2020, when the pandemic happened, you can see that was the next biggest spike here. And so if we move into a recession in 2025, it's possible that this could be a solid defensive inclusion in an ETF portfolio. Now that's the only bond fund that I've included in the list of 6 ETFs here. You can also look at other bonds, shorter duration, or corporate bonds. However, generally speaking, US long duration treasuries will be some of the safer ones, because if the US fails, basically everything that we can possibly invest in will probably be down anyways. Okay, the next inclusion in a recession-proof ETF portfolio here is XLP. Now this is an ETF that tracks consumer staples, and the reason why this is recession-proof is largely because these are things that people need to continue to purchase regardless of whether it's a bull market or a bear market. People need these items, and so these are the types of stocks or companies that produce these products will outperform versus, let's say, luxury goods, for example. So again, super low expense ratio, actually even lower than TLT, which you love to see. Assets under management of $14 billion. This ETF has been around since 1998, so it's got a long proven history of actually performing well. Now this one actually does have a dividend yield of 2.82%, so that's something to consider. You can get some cash flow on your investments. And then let's get to the more interesting part of this, which is holdings. What is actually included in this consumer staple basket? So you can see the list of names here on the left. These are the top holdings in the ETF. We're talking about things like Costco, Procter & Gamble, Walmart, Coca-Cola, interestingly enough, Philip Morris, cigarettes, basically a lot of food products that people have to buy regardless of whether or not it's a recession. So that is the consumer staple index. And if we just look at the all-time price performance, you can see that it's done very well. And in theory, this should have slightly lower downside during a recession than, for example, the S&P 500 or the NASDAQ. But if you compare it to actual growth rates of the S&P 500, which we can do if we actually chart XLP relative to the S&P 500, you can see that it has less volatility, but it also has less growth potential. So maybe during a bull market, this is not something that you would want to hold. However, during a bear market or a recession, this is a potential solid inclusion. XLP is the pink line, by the way, in case that wasn't clear. Okay, next up, we have got ticker symbol FUTY. This is the Fidelity MSCI Utilities Index. Just like the title says, these are utilities things that people need to pay for regardless of whether it's a recession or a bull market. You need to have lights in the house, you need to have power, aircon, heating, whatever. So the basics on this ETF, again, very low expense ratio. It has lower net assets than some of the other options that I have included in the list here, but still very solid at 1.7 billion. In terms of the top 10 holdings in this ETF, we're looking at basically just a bunch of energy companies listed in the US. Now there is a dividend yield on this one as well. It's slightly under 3%. And if we look at the all-time performance, it's kind of a similar story to the consumer staples, just slow and steady growth over time. If we add FUTY here, there we've got the purple line. And really the difference we can see in the chart here. So from the absolute peak of the S&P to the low, it was about minus 21.42%. But the drop from peak to the bottom on XLP was only 8.9%. And on FUTY, 8.62%. So that's why this is considered to be a defensive stock. Although if you hold it long term, you will miss out on these explosive periods of growth where, of course, the S&P outperforms. Okay, next up. Another thing that people need to pay for regardless of the market conditions is healthcare. And that's why we have a healthcare ETF on the list here. The ticker symbol is XLV. This is another really big one. $34 billion in assets under management, low expense ratio. The dividend yield of this one is 1.68%, so one of the lower ones that we've seen here. And then the top holdings include just a bunch of the biggest for-profit health companies around. Now, I guess we might as well continue to chart against our other comparators. So let's put XLV on the list here and check it out. That is the dark blue line, let's say, or light purple. Solid defensive performer, but actually seems to be tracking or having slightly more correlation to the S&P than the consumer staples or the utilities ETF that I mentioned. Okay, two more options to include here. Now, these are getting to be slightly different. So we went through the bond funds, then some of the categories of spending and the companies that will perform well in a recession. Now we're moving to something that just tries to minimize volatility. So this ETF here is from Invesco, and it is the high dividend, low volatility ETF. So what this does is it looks at the S&P 500, the 500 biggest companies in the US, and then removes from the index ones that have higher volatility and tries to focus on solid dividend payouts. So what you end up seeing is a much more stable price chart with lower risk and then some decent cash flow in that as well. So this is the funnel or the screens that they use here. They start by looking for high dividend, then they filter out ones that have high volatility, and then they weight it by dividend yield, resulting in the ETF here. So it's definitely an interesting inclusion in a defensive recession-proof portfolio. Now the yield on this one is the highest that we've seen so far at 3.24%. It does also have a higher expense ratio, the highest that we've seen so far, because it requires a little bit more of that active management at 0.3%. Net assets are 3.53 billion, so very solid. And if we chart it against all the other ones that we've included here, we can see that that is the green one here. So slight underperformance when it comes to the actual price of the ETF. However, you also get that higher dividend yield out of it. I just realized I never actually charted TLT here, so let's throw that in as well just to have the full comparison. All right, one final ETF that I wanted to mention that is a possible inclusion in a recession-proof ETF, although really only works well at the beginning of a recession, is this. Now, this is definitely riskier. This is a short S&P 500 ETF. So you only buy this if you think the S&P is going to continue going down. This has no leverage, so it's just a negative 1x of the S&P 500. The expense ratio is the highest of all of the ones that I've included here at 0.89%. It also has less than $1 billion in assets under management. And then in terms of what's included in this, literally just negative 1x of all of the S&P 500 index. Now, this is not an ETF that you want to hold for a long duration, because when you short an asset, you have to pay funding fees to short it. So there's basically costs that eat into the principal over time. through something called decay. So you don't want to hold this asset for a long time, and you certainly don't want to hold it once the market turns around. But at the beginning of a recession or at the beginning of a bear market, something like this can help recession-proof a portfolio and hedge to the downside. Let's clear the chart here and just take a look at the S&P over time. So in 2020, when the pandemic hit, we saw a very sharp decrease in the markets, with everything being down around 36%. But it was quick, and then we went into a very long and extended rally. And so really, the short ETF would only have been a good play during the beginning. Now, same thing with the current situation that we're facing. We're down 21% from the high. But this is not an ETF that you would want to hold if we've already bounced off the bottom and we continue ripping up, or we see a solid recovery. However, if you suspect that we may have further to drop before we see a recovery, then something like SH could be an inclusion. But this is the last one. It's the highest risk of all the ones that I mentioned and shouldn't be played with for people that don't have a pretty solid understanding of what they're doing. Those are 6 of the best recession-proof ETFs. Hopefully you found this video helpful. Thanks so much for watching and have a great day.